Hey guys, welcome back to Franco Dividend Investing. What a week we had. World Economic Forum in Davos, market tumbles on the news that coronavirus spreads in China, and my portfolio is growing. I would like to start this episode with an interview with Ray Dalio at World Economic Forum, where his main message was cash is trash. So let's listen.
We had David Tepper had texted into the show on Friday and suggested right now that you have to be in the market full on. And so the question is whether everybody jumps on the train, everybody gets in full on, and then the problem arises that you're talking about.
Likely.
But then the question is when do you jump off the train?
But also the question is, what do you jump into when you jump off the train? And the issue is you can't jump into cash. Cash is trash, okay? Cash is that they're going to, because they're going to print money. What do? You get out, okay? So cash is not going to.
So what do you do?
So what you have to do is you have to have a well-diversified portfolio. First of all, you have to be global, and you have to have balance. And I think, I don't want to grab. Well, the headline's going to be again anyway.
For those who don't know Ray Dalio is the founder of the Bridgewater Associates, an investment management fund with over 160 billions of assets under management. Ray Dalio is famous for his all-weather portfolio, which is risk-balanced. So you would see that his portfolio contains only 30% of stocks and 55% of bonds, and the other are commodities. So what you're asking? That based on the comments of the analyst, right now everyone should be on the market to get the gains which market provide nowadays. But if everyone will be on the market and then crash come, what to do then? So in the video, Ray Dalio doesn't disagree that you need to be on the market. Do not stay with cash, invest cash. But what he says that your portfolio should be diversified. It should be global and it should contain different kind of assets, not only stocks, but as well bonds and commodities. Some of you would say, well, what then about Warren Buffett and his cash pile, which is right now is already more than 120 billion. Well, let's hear what Warren Buffett says about his cash pile himself.
We're not going to change. We do like having a lot of money to be able to operate very fast and very big, and we don't, and maybe we won't. We know we won't get those opportunities frequently. I don't think, certainly, in the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold, and all you have to do is go outside. But we don't know when they will happen. And the one thing you should very definitely understand about Berkshire is that we run the business in a way that we think is consistent with serving shareholders who have virtually all of their net worth in Berkshire. I happen to be in that position myself, but I would do it that way under any circumstances. We have a lot of people who trust us, who really have disproportionate amounts of Berkshire compared to their net worth if you were to follow standard investment procedures. And we want to make money for everybody, but we want to make very, very sure that we don't lose permanently money for anybody that buys our stock somewhere around intrinsic business value to begin with. We just have an aversion to having 1 million plus shareholders, maybe as many as 2 million, and having a lot of them ever really lose money if they're willing to stay with us for a while. And we know how people behave when the world generally is upset.
As you see, Warren Buffett keeps his cash and cash equivalents for opportunities. But is it a pure cash? If we take a look in his financials, we will see that at the end of 2018, his cash position was over $108 billion, but only 27 billion was in the form of pure cash and short-term treasury bills with maturity of 3 months or less, and 81 billion was the short-term investments in treasury bills. So he committed to hold minimum 20 billion in pure cash for unforeseen events. All the rest is just short-term investments in the US treasury bills, which still brings him some yield. If we take a look on the current state, he has approximately 128 billion in cash. But if we compare it to the total amount of assets, which is 788 billion, the cash and cash equivalents corresponds still to approximately 16% of his total assets. Part of this cash and cash equivalents are pure cash, but most part of it is the short-term investments in treasury bills, and if the opportunity will arise on the market, he will have a possibility to quickly deploy the cash into those opportunities. So here we heard two different thoughts of investors. One is claiming cash is trash, and one is keeping over 100 billion in cash and cash equivalents. So what's the lesson we can learn from it? I believe the main lesson is that you need to learn and understand which investing strategy suits you. You can consider growth investing with much higher risks. You can consider risk-averse investing, investing more into bonds. For myself, I choose dividend investing strategy, where every month I'm investing into well-established companies that pays me dividends. Their growth, compared to some growth stocks, are much lower, but on a usual basis they pay out at cash dividends to their investors. Well, of course, one can argue, if the company would reinvest itself those dividends into development of the company and business, its growth would be much higher. But for me as an investor, I have this choice what I do with my dividends. Either I reinvest them myself, or I use it to cash my expenses. For the moment, I'm focusing on building my portfolio with solid companies and reinvesting all the income into the portfolio. But in the future, when the monthly income from this portfolio will be enough to cover my operating expenses, I can use it to live from it. Well, now let's see what happened to my portfolio over the last week. So the latest purchase was Travelers Companies. Travelers is an insurance company with a history of over 160 years and with the main operations in US, Canada, UK and Ireland. With this addition, the value of my portfolio is roughly over 4,400. And currently the projected annual dividends are coming closer to $100. Over the last week, I as well received a dividend from Cisco. So the total dividends received up to now is $10.45, including already 30% dividend withholding tax. The capital gains shrink a little bit compared to the last week due to the general market slowdown because of the uncertainty around the coronavirus in China. I will use this market slowdown to rebalance my initial purchases of the portfolio, which are lower weight right now. This would be it for this week. If you would like to consider following development of this portfolio, please subscribe, and if you have any questions, feel free to put them in a comment. Thank you and bye.